The Fed just ended QT, and every liquidity crisis starts. Exactly this way. December 1st, 2025. At first glance, it felt like any other Monday on Wall Street. No emergency meetings, no special announcements, no market meltdown. But behind the scenes, inside the plumbing of America's financial system, something major just shifted. After almost 3 years of draining money out of the economy, the Federal Reserve's balance sheet finally stopped shrinking. Quantitative tightening, or QT, the process where the Fed pulls liquidity out of the system, had officially ended. Most people didn't notice. News outlets barely covered it. But anyone who truly understands how the system works, the people who watch liquidity, not headlines, recognize the significance immediately. Because QT ending is never just a policy milestone. It's a turning point, a trigger. And the biggest clue came just a few hours later. On the exact same day QT stopped, the Fed quietly injected $13.5 billion into the financial system through an overnight repo operation. No press release, no explanation from Powell. It just appeared like a pressure valve being forced open before something cracks. Here's the part no one is talking about. Nothing bad happened on December 1st. The economy wasn't collapsing, jobs weren't evaporating, inflation wasn't exploding, there was no visible emergency. And that's exactly why this moment matters. When the Fed steps in without a crisis, it means the stress is coming from inside the infrastructure of the financial system. The wiring, not the wallpaper. Something underneath was reaching its limit. Because if QT had actually accomplished its mission, if the system were healthy, the Fed wouldn't need to pump billions back in on the very day runoff ended. For people who understand liquidity cycles, this raises the only question that matters over the next 2 years. For markets, for assets, and for anyone protecting their wealth. If QT didn't end because inflation was beaten, but because the system was quietly running out of room, then what happens next? To understand why the Fed had to end QT, we need to rewind and look at what officials were quietly hinting at in the weeks leading up to December 1st. These weren't dramatic speeches. They were subtle warnings, the kind that only makes sense once the picture becomes clear. On October 29th, Jerome Powell announced the Fed would end QT on December 1st. No urgency, no admission of stress. But the numbers didn't support the timing. Inflation was still above target. The economy wasn't weakening. Nothing suggested the Fed needed to stop tightening. Then came the real clue. John Williams, the president of the New York Fed and the person responsible for monitoring the actual flow of money through the system, said bank reserves had fallen from abundant to somewhat above ample. To most people, that sounds harmless. But in central bank language, this is a flashing red light. Ample is the lowest safe zone. Go below it, and the system starts to malfunction. And in November, the malfunctions began. Repo rates, the interest rates banks pay to borrow overnight, began creeping above the Fed's target range. That's not supposed to happen. Meanwhile, banks started tapping the Fed's standing repo facility more aggressively. $15 billion, then $18 billion, then $24 billion. Levels we hadn't seen since the chaos of 2020. And then came the bluntest warning of all. Lori Logan, head of the Dallas Fed and former leader of the New York Fed's market desk, stated publicly that if repo rates stayed elevated, the Fed would need to start buying assets again to keep reserves from falling too low. Not might need, not should consider, would need. Put the clues together and the truth becomes unavoidable. QT didn't end because the economy was stable. QT ended because the financial system was running out of oxygen. And the Fed knew one more month of tightening could break the plumbing. QT didn't die from success. It died from strain. If you've ever lived in an old apartment building, you know the feeling. You turn the faucet, and instead of a steady stream, the water sputters. Not because the city ran out of water, but because the internal pipes can't maintain pressure. That's exactly what happened to the US dollar funding system in late 2025. On the surface, everything looked normal. Stocks were stable. Bond yields weren't flashing panic, but underneath, the pressure in the pipes was dropping. Repo, the overnight funding market banks depend on, is that pressure. When repo rates jump above the Fed's target, it's the monetary equivalent of pipes rattling in the walls. And when banks begin tapping the standing repo facility day after day, that's the moment the building superintendent knows something is seriously wrong. There was another warning sign almost no one talked about. The reverse repo facility, a buffer that once held over $2.5 trillion, had drained to near zero by late 2025. That buffer had protected the system for 2 years, allowing QT to run without immediate pain. But once it dried up, the system had no shock absorber left. Any additional tightening hit the banks directly. This is what Williams meant when he said reserves were slipping toward ample. This is what Logan meant when she said the Fed may need to begin buying assets again. It wasn't academic theory, it was a diagnosis. The plumbing was hitting its lower bound. If reserves fell further, the next step wouldn't be a mild slowdown. It would be a repeat of 2019's repo explosion, when overnight rates spiked to nearly 10% in a single session, and the Fed had to intervene within hours. In a world built on leverage, liquidity is oxygen. And by late 2025, oxygen was getting thin. After December 1st, Fed officials went out of their way to avoid one specific phrase: quantitative easing. They didn't want headlines declaring a policy reversal. They didn't want markets assuming rate cuts were imminent. And they definitely didn't want Congress accusing them of monetizing government debt. So instead, they used softer language: reserve management purchases, maintaining ample reserves, technical adjustments. But the mechanics are not soft at all. In speech after speech, both Powell and Williams made the same point with carefully chosen words. Once QT ends, the balance sheet must begin expanding again to match the growing liabilities of the banking system. Reserves cannot shrink forever. At some point, the Fed has to supply more. This is the quiet truth behind modern monetary plumbing. The system grows, therefore the balance sheet must grow. Research groups like Evercore and reporting from the Financial Times began modeling what this technical expansion might look like. Their numbers were not small: $20 to $50 billion per month in 2026, just to keep reserves from slipping too low. Some estimates went as high as $80 billion during the early phase. Call it whatever you want. When the central bank buys treasury bills and adds reserves into the banking system, that is liquidity injection. That is balance sheet expansion. That is, in every functional sense, QE. But here's the twist. The Fed isn't doing this because the economy needs stimulus. They're doing it because the system needs stability. This is exactly what happened in late 2019. The Fed said it wasn't QE. Markets treated it as QE anyway. Asset prices didn't care about the label. They cared about the direction of liquidity. And now, in December 2025, the direction has changed again. To understand where 2026 may be headed, we need to rewind to the last time the Federal Reserve tried to shrink its balance sheet. The year was 2019, the forgotten prelude to the pandemic. QT had been running for almost 2 years. The Fed kept saying reserves were abundant. Everything looked calm. Until it didn't. On September 16, 2019, something snapped. Overnight repo rates, which normally hovered around the Fed funds rate, suddenly surged. Within hours, liquidity vanished. At one point, repo spiked close to 10%, an unimaginable number for what is supposed to be the safest, most liquid corner of the financial system. The next morning, the New York Fed intervened with emergency repo injections. Not optional, not gradual, immediate. 2 weeks later, on October 1st, the Fed announced it would begin buying $60 billion per month in Treasury bills. Powell insisted this was not QE, just a technical operation to stabilize reserves. But the market knew better. By early 2020, the Fed's balance sheet had quietly expanded by over $270 billion, and asset prices reacted instantly. From early September 2019 to the pre-COVID peak in February 2020, the S&P 500 climbed nearly 20%. The Nasdaq surged over 25%. Gold pushed higher. Bitcoin rallied more than 200%. None of this was driven by earnings. None of it was about growth. It was about liquidity. When the Fed stops draining the system and starts supplying it again, no matter the label, markets move. The direction of liquidity is the direction of risk assets. The key takeaway is not that 2026 will mimic 2019 point for point. It's that markets respond to liquidity shifts immediately, long before the economy. The moment the Fed flips from tightening to expanding, the market senses it and front-runs it. And as of December 1st, 2025, that flip has already occurred. If 2019 was a spark, 2026 has the ingredients for a full-on liquidity wave. Not because the Fed wants one, but because the system may require one even larger than before. Here's why this setup is fundamentally different, and potentially more powerful than anything we saw in the previous cycle. First, the starting balance sheet is massive. In 2019, QT stopped with the Fed's assets near $3.8 trillion. In 2025, QT ends with the balance sheet at $6.6 trillion, nearly double the size. A system this large needs a correspondingly larger liquidity cushion. Third, the protective buffer that allowed QT to run so long, the reverse repo facility, is gone. In 2019, it didn't exist. In 2024, it held trillions. By late 2025, it is nearly empty. Without that reservoir, any additional tightening hits the banking system directly. Fourth, the political backdrop is shifting. Powell's term ends in May 2026. Markets expect the next Fed chair to be more dovish, especially under an administration already signaling it wants lower rates. Whether or not those expectations are accurate, the anticipation alone can amplify liquidity-driven moves. None of this guarantees a straight-line rally. Nothing in markets ever does. But it sets the stage for something we've seen repeatedly. When liquidity returns to a system built on leverage, the reaction is nonlinear. It accelerates. And 2026 may be the year that acceleration begins. To understand what a renewed balance sheet expansion could mean, you have to look back at the last time the Fed unleashed a flood of liquidity, 2020 and 2021. Yes, the pandemic distorted everything. Yes, lockdowns and stimulus checks created noise. But beneath all of that was a simple mechanical truth. When the Fed opens the fire hose, asset prices respond with force. Between early 2020 and the end of 2021, the Fed's balance sheet grew from roughly $4 trillion to nearly $9 trillion. Whether you were looking at tech stocks, long-duration assets, gold, or Bitcoin, the reaction was unmistakable. Liquidity lifted everything. Not because the economy was booming, but because capital suddenly had nowhere else to go. Now imagine something similar happening again. But this time, without a global shutdown, without a deflationary shock, and without the same level of economic uncertainty that clouded decision-making in 2020. Imagine a liquidity wave that occurs not because the Fed wants to stimulate growth, but because the structure of the financial system forces them to stabilize reserves. The direction of liquidity would be the same, but the backdrop radically different. In 2020, households were scared. Businesses were frozen. Investors were defensive. Liquidity entered a world that wasn't ready to deploy it. But 2026? 2026 is shaping up to be a completely different environment. AI investment cycles are accelerating. Capital expenditures are rising for the first time in decades. Corporate balance sheets are healthier than in 2020. The fiscal machine is already running at a sprint, which leads to the real possibility, a liquidity wave without the economic paralysis that muted the early stages of 2020. That is what makes this cycle dangerous for those sitting on the sidelines, and potentially transformative for those positioned ahead of time. Even if the Fed wanted to keep shrinking its balance sheet, something much bigger stands in the way: fiscal dominance. The United States is entering an era where deficits are no longer temporary or cyclical, they are structural. The Congressional Budget Office estimates that federal deficits will run between $1.5 and $2 trillion per year for the foreseeable future. And that's in a good economy with low unemployment. Layer on top of that, interest costs on the national debt now exceed the defense budget. Demographic pressures are increasing entitlement spending every single year. Tax revenues have become more volatile as the economy shifts toward intangible industries. In other words, the train isn't slowing down. And as macro analyst Lynn Alden famously put it, nothing stops this train. This is the core problem. Deficits must be financed. Treasury issuance must be absorbed. And someone has to buy those trillions in new debt. Foreign central banks are no longer net buyers. U.S. banks have limited balance sheet room. Money market funds already deployed their RRP balances, which leaves the Federal Reserve. Not because they want to monetize debt, not because they want to juice markets, but because the system is built in a way that leaves them no alternative when liquidity gets tight. When the fiscal side accelerates and the monetary side pulls back, the strain always shows up in the plumbing first: repo, reserves, bill yields. Every time, the solution eventually becomes the same: expand liquidity. This is not politics. This is not ideology. This is mechanics. And mechanics are harder to escape than policy. Liquidity feels abstract until it hits your life. And it always does. When the Fed shifts from draining liquidity to adding it back, the first thing most people notice isn't a headline, it's a price. Mortgage rates drift lower, not enough to make housing cheap, but enough to ignite demand again. Suddenly, home prices start rising faster than wages. The house you hesitated to buy at $480,000 is now $530,000, then $560,000, then gone. The stock market begins climbing. At first it feels random. Tech stocks inch higher, then momentum takes over. Retirement accounts recover. The fear fades, but for many the opportunity already slipped by. And then everything else begins to follow. Rent rises. Insurance costs rise. Food prices tick up. Asset owners get richer. Savers get squeezed. This is the quiet shift most Americans never see. The wealth transfer caused by liquidity, not by effort. In a debt-based system, sitting in cash is almost always a losing strategy. Not because cash is bad, but because the system is designed to inflate away its value over time. During every liquidity wave, the same pattern repeats. People wait for certainty. They wait for better headlines. They wait for the moment when everything feels safe. But by the time things feel safe, liquidity has already done its work. Prices have already moved. The ladder has already pulled a few rungs higher. This is why wealth tends to accumulate with those who understand the cycle, not those who wait for permission. Because liquidity doesn't reward patience. It rewards preparation. Every macro thesis needs a risk. Not a black swan, but a gray swan. Something visible, but unpredictable. And in 2026, the biggest gray swan isn't inflation. It isn't unemployment. It isn't the Fed. It's political instability. For the first time in decades, the United States is experiencing elevated institutional conflict across almost every major pillar of governance. States are clashing with the federal government. Courts are stepping into policy battles normally settled through legislation. Agencies are openly contradicting each other. The upcoming political cycle is shaping up to be one of the most combative in modern history. None of this guarantees a crisis, but it increases the probability of fracture points, moments when the market's expectation of smooth policy coordination breaks down. Why does this matter for liquidity? Because liquidity waves rely on confidence in the system's ability to function. It doesn't require harmony, but it does require predictability, and political stress can affect timing. It can accelerate the Fed's interventions or delay them. It can tighten credit conditions unexpectedly. It can trigger safe haven flows. It can create volatility spikes that temporarily derail even the strongest liquidity-driven rally. This doesn't invalidate the broader pattern. Historically, liquidity still dominates over the medium term, but political shocks can shift the shape of the wave, how fast it rises, how cleanly it moves, and how long it lasts. The gray swan isn't here to change the destination. It's here to remind us that the path is never a straight line. Understanding this doesn't make the risk smaller. It makes us less likely to be blindsided when volatility arrives, and more prepared to act through it instead of freezing beneath it. Every liquidity cycle exposes the same divide. Not between the rich and poor, not between bulls and bears, but between those who understand the system and those who react to the news. Headlines say recession risk. Liquidity says conditions easing. Headlines say inflation still too high. Liquidity says balance sheet expansion ahead. Headlines say markets look unstable. Liquidity says oxygen returning. This is the paradox of modern finance. The better the headlines, the worse the forward returns. The scarier the headlines, the stronger the liquidity impulse that often follows. But most people don't see this until the move is already underway. A fund manager with 30 years of experience once put it like this. By the time the news looks safe, the rally is already over. Liquidity moves first, prices move second, narratives move last. That's why the biggest mistake investors make isn't being wrong. It's being late. Volatility shakes them out. Headlines freeze them. Certainty becomes their prison. They wait for confirmation that never comes, and miss the wave unfolding right in front of them. Understanding the system changes everything. You stop asking, is the economy good or bad? You start asking, is liquidity tightening or easing? You stop reacting to noise. You start anticipating direction. QT ending wasn't a headline. It was a transition. Liquidity injections weren't breaking news. They were signals. And history, 2008, 2013, 2019, 2020, shows what happens when those signals align. Assets that depend on liquidity respond violently long before the mainstream realizes what's happening. The question isn't whether liquidity is returning. It already has. The real question is, will you be positioned when the rest of the world finally notices? Scroll back through 20 years of Federal Reserve history and a striking pattern emerges. Every time the balance sheet contracts to the edge of the system's tolerance, 2008, 2013, 2019, 2025, there's a moment when the line stops falling, pauses, and turns. That inflection point is never loud. It never comes with celebration. It rarely makes front-page news, but it is always the beginning of the next chapter. The day QT ended in 2025 will be remembered the same way, not because of what happened that day, but because of what it set in motion. A liquidity cycle that will define 2026 and 2027, a shift in oxygen flow that will lift some assets and leave others behind, a turning point that only becomes obvious in hindsight. History doesn't repeat, but it rhymes with astonishing precision. When the Fed stopped shrinking in 2019, markets surged. When the Fed expanded aggressively in 2020, assets exploded higher. When the Fed paused, tightening in 2025, the plumbing breathed again, and liquidity quietly began to return. The future will not copy the past, but it will echo it. Some people will wait for clarity. Some will wait for headlines to tell them what already happened. Some will miss the wave, not because they lacked intelligence, but because they lacked perspective. But those who understand the cycle, those who know how the system actually works, those who see the turn before the narrative catches up, they won't be reacting to the news. They'll be anticipating the future. Because in a world built on liquidity, the most valuable skill is not prediction, it is recognition. And once you recognize the cycle, you stop fearing the turning point and start preparing for what comes after it.